Okay, let's dive right into this. Welcome to today's explainer, where we're unpacking what might just be the absolute most consequential near-term data release of the entire year for the precious metals market. Right now, there is just this massive, palpable tension surrounding gold's immediate future. We're talking about a market that is quite literally holding its breath. It's caught in this high-stakes tug of war between stubborn inflation on one side and the Federal Reserve's interest rate policies on the other. So if you've been watching the charts lately and wondering why gold feels like a tightly coiled spring, well, you're definitely in the right place. We're going to break down exactly what's happening using the data and analysis straight from Kitco News and map out precisely what you need to be watching for.
But, to really understand where we are right now, we first have to look at where we've been. Gold has bled a staggering 22% of its value since hitting that all-time record high of $5,595 an ounce back on January 29th. Just think about that for a second. 22%. That is a massive, painful correction for literally any asset class. And this sharp decline, it hasn't just happened in a vacuum. It's been driven largely by the complete collapse of rate cut expectations that investors had eagerly priced in earlier in the year, combined with, an easing of those geopolitical tensions that had heavily supported bullion through the first quarter. Basically, the momentum shifted aggressively, and it pulled the rug right out from under the gold bulls.
And that incredibly steep drop brings us right here to $4,300 per ounce. This right here is the critical line in the sand. Gold is currently hovering right around this level, and it served as this sort of intermittent floor of support since April. But let's be honest, it's a really fragile floor. The market is trading in a total defensive crouch right now, desperately waiting for a new catalyst to dictate its next major move. So will this support actually hold, or are we about to see another painful leg down? Well, the answer to that question relies entirely on what happens next.
Which brings us to the first part of our breakdown, the catalyst. Enter the CPI. So what exactly is causing all this acute market anxiety? It all comes down to Wednesday's highly anticipated May Consumer Price Index report.
Now, you probably already know CPI is the primary gauge for inflation, measuring the average change in consumer prices. But it matters immensely to gold investors right now. Why? Because this single, solitary metric is what dictates the Federal Reserve's interest rate expectations. With the Fed holding rates steady for months in the face of some really sticky inflation, the whole shebang hinges on whether this CPI number shows prices cooling down or, worst-case scenario, heating back up. Let's walk through the stepping stones that brought us to this current crisis point. Step 1. The April CPI reading came in at 3.8% year-over-year. That was the highest we'd seen since May of 2023, and it was primarily this energy-driven anomaly caused by the Iran-Israel conflict spiking supply fears. Okay, step 2. That single hot print was the pivotal moment that just crushed rate cut expectations and totally turned the tide against gold. Which leads us to step 3, and honestly the terrifying reality facing traders today. The consensus for the May CPI predicts headline inflation accelerating even further to a really hot 4.2%.
Moving on to the crossroads bull versus bear. Now, what's really interesting here is that this upcoming CPI print isn't just another data point. It is a massive binary fork in the road. Let's clearly contrast the cause and effect of these two distinct paths. On the left side, we have the bear scenario. If CPI comes in at or above that 4.2% consensus, it confirms inflation is reaccelerating. That completely validates the idea of rate hikes, it sends real yields spiking sharply higher, and that crucial $4,300 support we just talked about, it almost certainly breaks. But on the right side, the bullish scenario, while narrower, is incredibly meaningful. A soft CPI below expectations signals that April was just an energy-driven aberration. That weakens the dollar, keeps hopes alive for a September rate cut, and could actually ignite a relief rally, pushing gold right back toward the $4,500 area. And to really grasp the severity of the bearish side of this equation, just look at how sticky inflation fears have caused major Wall Street banks to do a complete 180. Goldman Sachs recently removed all remaining 2026 rate cuts from its baseline. They pushed their first expected cut all the way back to June 2027. They even raised the probability of a minor rate hike to 20%. BNP Paribas has gone even further than that. They're expecting the Fed to begin raising rates this December, with hikes continuing into 2027. So a hot CPI print directly validates these exact fears, putting massive downward pressure on gold. Next up, the 1-2 punch. Here is the real dramatic twist in today's explainer. The CPI report, it isn't acting alone. It's actually part of a consecutive 2-event sequence. Let's lay out the timeline. Wednesday morning gives us the May CPI release, but immediately following that, on June 16th and 17th, the Federal Open Market Committee, the FOMC, convenes.
The timing here makes Wednesday's release uniquely important purely because of what happens literally days later.
I absolutely love how the Kitco commentary perfectly illustrates this relationship with a vivid quote. Wednesday's number sets the table. June 17 serves the meal. Think about that. The inflation data shapes the market's expectations and mood for sure, but that subsequent Federal Reserve meeting, that is where the actual policy response is delivered. And this specific FOMC meeting is uniquely crucial for two major reasons. First, it marks the debut of new Fed Chair Kevin Warsh, who took over after Jerome Powell left in May. And second, it's a summary of economic projections meeting. That means traders receive an updated dot plot, which is basically a chart summarizing where Fed officials project interest rates are heading over the next few years. It is the most complete signal the Fed can send. So, a hot CPI followed by a hawkish debut from Chair Warsh? That would be the absolute worst-case scenario for gold.
And just to add a little more fuel to the fire, look at this surprising fact from the labor market. The May non-farm payrolls report showed 172,000 new jobs added, which was well ahead of consensus. This incredibly resilient labor market has basically already killed off any serious probability of a June rate cut. It reinforces the argument that the economy is just too strong for the Fed to ease up right now. And that, in turn, places immense, outsized weight on Wednesday's CPI. It's essentially the very last variable left that could somehow alter the Fed's policy calculus this week.
So let's talk about the structural floor. The crucial point here is, with all these rate hike fears and a massive 22% correction, you might be wondering, why hasn't gold just fallen completely off a cliff?
Well, let's zoom out to the macro view. What's keeping gold afloat is a massive, persistent structural demand that operates completely independently of short-term U.S. interest rate dynamics. Just walk through this staggering data with me. Globally, central banks purchased 1,237 tons of gold in 2025. That's the third straight year exceeding 1,000 tons. The People's Bank of China just added another 9.95 tons in May alone. That's their 19th consecutive month of accumulation. And looking at the broader picture, the World Gold Council reports that global demand reached a record $193 billion in the first quarter of 2026. These incredible, sustained flows have essentially built a durable structural floor beneath each wave of this current correction.
And this brilliantly illustrates the big takeaway from the macro view. Yes, the market is super anxious right now. Yes, there has been an agonizing 22% correction since the January peak. But because of that relentless structural central bank demand, gold still remains more than 28% above its year-ago level. The structural bull market's integrity remains entirely intact by almost any long-term measure you look at.
Which leaves us with the ultimate question: where does gold go from here? For anyone closely following this market, the takeaway is clear. You have a massive structural bull market supported by global central banks, and it's colliding head-on with a genuinely terrifying near-term interest rate environment. And right now, one single inflation print stands between gold and its next decisive move. Will it trigger a painful bear phase dropping below 4,300, or will it ignite the relief rally investors have been praying for? Well,